It wasn't that long ago that Duolingo had a stock that was worth nearly $500 per share. And boy, does it seem like that was a long time ago, as the company reported earnings after the market closed yesterday, and it's now trading under $100 per share, roughly an 80% drop. So, what does this mean for shareholders? My name is Brian Stoffel. We're going to spend the next couple of minutes trying to figure this out. At the time of this recording, I do own shares of Duolingo, and I want to give a shout out to Fiscal AI for sponsoring today's video. More from them in just a bit. So here's the thing that's interesting. We're going to look at Duolingo's fourth quarter 2025. As of today, it's about $4.5 billion company, which is pretty small. But if we look at the current quarter, you might be surprised because the numbers are actually pretty good. Revenue grew 35%, and that beat analyst estimates and Wall Street's guidance and the company's own estimates. Earnings per share came in at 84 cents. That's almost tripling from the same time last year and very slightly ahead of Wall Street's estimates. Now, if we look at margins, there was a ton to love here. Gross margins expanded. Operating margins more than doubled. Net margins more than doubled. Gotta love that. Free cash flow was up much less so. Net income increased a ton. And the balance sheet is in great shape with a net cash position of over $1 billion. I mean, let's look at this income statement. You can see what I'm talking about. Revenues up 35%, and the cost of those revenues only up 31%. And that's even with the focus on AI and some of their higher tiered plans and needing to pay tokens for that. Gross profit increased even more, up 37%. And look at this. Operating expenses, whether it's R&D, sales and marketing, what have you, those are only up 19%. If you can grow revenue 35%, gross profit even faster, and operating expenses are meaningfully lower, this is what happens. Your income from operations more than triples. So when we look backwards, there's a lot to like about what's going on. So why is Duolingo in the position it's in? Well, let's go to the shareholder letter, and we'll start to see that when you look forward, it's a decidedly different picture. So we start here, where the company's co-founder and CEO, Luis van Aan, had this to say, that DAU, which is daily active users, key metric, has been incredible, 40% or more for a couple of years. But what they said was that decelerated throughout 2025, and then look at this is the big one. They expect daily active users growth to be about 20%. Now, of course, 20% is still pretty good. But when we're used to 40% and we see a huge drop off, well, that is meaningful. So why did that happen? And what are they going to do to fix that? Well, they said that some of this deceleration in daily active users, because remember, this is a freemium model. Most of their users use it for free, okay? And they are trying to convert those free users to paid users, and they said that the friction that they've introduced, like encouraging more people to subscribe by increasing the number of ads or upsells, that is part of the reason that daily active users have slowed, because people they just don't want to deal with the sales pitch anymore, and so they're changing that. And the company also said that, so now they're focused on growing their daily active users to 100 million. 100 million daily active users by the end of 2028. Remember that number because it's going to be important. Because if they're able to grow to 100 million daily active users by 2028, that would mean daily active user growth of 24% over the next 3 years. So if daily active users only grows about 20% this year, 2026, it'll be even faster, probably 25, 26, 27% growth in 2027 and 2028. That's a big deal. But the short-term implication is that they'll see slower bookings and lower profitability. Remember, bookings is like money that Duolingo has already collected. They just don't get to recognize it as revenue because people usually pay for an annual plan. And so in the first quarter that they're on that, they only recognize a quarter of that money. And then the second quarter, and so on and so forth. And they expect that growth to only be around 11%. That's another number that you got to remember because it'll be important moving forward. They also expect lower profitability because they intend to give more of their higher level functionality to free users to grow that base. And that is going to pull down their margins. So there's a lot going on here. And I want to show this right now because the company offered revenue guidance for the full year. Now, Wall Street was expecting 22% growth, but management said, nope, it's going to be considerably slower than that. It's 16% growth. Now, let's put all of these numbers in context by heading on over to Fiscal AI, the sponsor of today's video. Because look, this is the best tool out there for individual investors. If you want to use it, simply click the top link in the show notes below. So what I've done first is I've gone here to just show you the revenue growth rate at Duolingo over the last couple of years. Now that growth rate is coming down, but at a completely reasonable rate. You can't be growing 55% forever. And you see it came down very nicely, 55 to 47 to 44 to 41 to 39 this year, 39% growth. And what we're saying is it's going to go from 39 all the way down to 16. That is a huge reason that shares are down so much today. Let's look at a couple other numbers right here. And right here, this actually doesn't include the most recent quarter, so I'll tell you what the numbers are. But what you can see here, again, is that this is monthly active users, so people that use it at least once per month, came in at 135 million during the September quarter. Right now, it was actually at 133 million. So again, it took a step backwards. It took a step backwards during the year. And it grew at just 14%. So we saw it go from 20% all the way down to 14%. That's not good. This number should consistently be growing. And the fact that it took a step backwards is not encouraging. If we look at daily active users, which is really the key one that everybody was focusing on, this did increase. So what we're seeing is a lot of, if monthly active users is going down and daily active users is going up, it means that our casual people that are using this, they're not sticking with it. And so it was 50 million people last quarter. It's now at about 53 million. So 53 million. Here's the problem. This growth rate continues to really slow. It was just 30% during the quarter. And remember, we're saying that it's going to slow now from 40s and high 30s all the way down to about 20%. Again, that's a huge reason that this is happening right now. Now, as I said, most of these subscribers are free, so it's worth looking at paid subscribers. And the growth here was actually pretty good. It was at 11.5 million paid subscribers last quarter. It came in at 12.2 this quarter, which is growth of about 28%. To me, that's a reasonable deceleration from 36 to 34. 28 is a little bit more of a slowdown. And so you're seeing a lot of slowdowns kind of across the board here. The last thing I want to show is subscription bookings. This is a huge number because what this number shows is it's money that the company has already collected. So subscription bookings were at $240 million last quarter. They came in at $297 million this quarter. Here's the problem. These subscription bookings had been above 40% for the last couple of years. The first time they broke below 40% was just last quarter, where they came in at 36%. This quarter, it only lasted in the 30s for one quarter, and it dropped down to 25% in this quarter. The last thing that I just want to show, because this is really important, is Duolingo's ability to convert their free users to paid users. And on this one, actually, things do look good. What I have done is I've taken paid users divided by monthly active users. And what we see here is that it was at 8.5% last quarter, but it actually jumped to 9.2%. Now, while you might think that's good, part of this is because, remember, monthly active users fell. It fell, so that denominator is smaller. So that's kind of a mixed bag. And so you can see how there are signs of a slowdown across the board. And management knows this. And they've said, we are now pivoting. What we are going to focus on is creating the best free product possible. And the idea here is that if you've got 100 million people using this on a daily basis, and if you can get, let's say, 10, 12% of those 100 million people to use it, well, then your paid subscribers is going to go up meaningfully. Okay, let's remember again, if we look at paid subscribers, if you've got 100 million people using this daily, okay, then you could have upwards of 20 million paid subscribers, which would be leaps and bounds more than where they are right now. But you have to get the base there first, which is what management is focusing on. So as a shareholder myself, what am I going to watch moving forward? Well, the first thing that I'm going to watch is that daily active user growth. Management has said it's going to be at around 20% in total for the rest of 2026. They expect it to actually pick up speed a little bit in the third and fourth quarter, which means the first and second quarter might actually be lower than 20%. Keep an eye on that. Second, bookings, because remember, that is the money that the company collects. They're only expecting 11% growth in bookings. That hurts. Third, I'm going to watch those operating margins. I know they're going to get hurt, but I want to see by how much. And fourth, paid conversions. I might start looking at paid conversions as a percentage of daily instead of monthly active users, because that might be a better way of looking at it. Look, the moat here is uncertain, because the moat here is really the company's brand value and its switching costs. And I consider those to be sticky switching costs, because once you get in, you don't really leave. And we still see that. The thing is, to get people in the front door of Duolingo, that's brand value. To keep people there and lock the back door, that is the switching costs. And right now we have a front door problem. The back door is fine, but the front door has a problem. So the thesis to me is very uncertain watching this. Now look, as I said, I've been a shareholder of this company for quite some time. And owning shares of Duolingo has definitely hurt my portfolio. And yet, you can see that since the end of 2014 to today, my portfolio in the green has still almost six-bagged during that time, and that is ahead of both the NASDAQ Composite and well ahead of the S&P 500. Now, you better believe that this is something we're going to be discussing in my investing community, Stock Investing Mentor. If you'd like to become a member, there's 3 parts to this. The first is 1 hour of live video instruction every week, noon Thursdays Eastern, that is recorded. Number 2, you get full access to my real life portfolio, including a video description whenever I make a move. And number 3, 24/7 access to a private online investing community. If you'd like to join and get 10% off, click the second link in the show notes below, but that 10% off deal will end at the end of the weekend on Sunday, March 1st. So let's talk about where we are with Duolingo and its valuation, because the fact of the matter is that with such great performance looking backwards and with the company being down so much, it looks cheaper than it's been pretty much at any point. We're looking at a company that today is trading for 23 times forward earnings. Over the last couple of years, on average, it's traded for almost 100 times forward earnings. Is 23 a fair price? That's tough to say. It depends on what you believe. The company is growing its revenue at about 16%. Or we could look at it on a forward price to free cash flow basis, and it's just trading at 11 times forward free cash flow. So, I mean, that appears very cheap. But I think what we should really do here is we should do a reverse discounted cash flow analysis. Now, I also think that we should be bearish in how we look at it. Here's what I mean by that. If we look at the company's free cash flow margins that it has had since, it became free cash flow positive, what we see here is that on an annual basis, the company has done a great job at generating free cash flow, about 36% over the last 2 years. However, I think that we should assume that it'll come back down to, let's say, 30% as there are pressures on the company. Let's even make it 28%. If we give the company 28% free cash flow margins, and we do that off of the current base of $1.04 billion, then what we have here is a company that we're actually going to put this in, and it's going to be lower than it actually is. That Duolingo would have roughly about $295 billion in trailing free cash flow. Let's also give it a low terminal discount rate of just 1%. So these are very bearish assumptions. Now, if the company can hit these more bearish consumptions, how fast does it need to grow moving forward? It needs to grow revenue now at about 5% per year. So let's think about that. Can this company grow revenue at 5% per year? Here's what it boils down to. It's already saying it'll grow it at about 16% next year. And they will probably beat those estimates because this management team usually sets out guidance that it can beat. The big question becomes this. Remember, the back door works. Once people enter the program, they tend to stay. It's the front door that's broken. Whether it's because of too much friction, whether it's because AI is a threat, whether it's because they had some social media snafus that it really didn't rub people the right way, whether it's because new entrants will come based on these AI tools that drive prices down or take subscribers. That's a lot of things to fix, but if they can fix that part and really get free users to come in, they've already shown that they do a good job of converting those free users to paid users. So if they can fix the front door, it is a phenomenal opportunity today. And here's the tough thing that investors need to remember, especially like myself, who've been invested in this company for a longer time. You can't worry about when you bought or where you bought if you're sitting here today owning it. The only question that matters to ask yourself is this. Forgetting everything that happened in the past, would you, if you didn't own it today, buy it today, given the risk-reward profile? That is the question that we're going to be tackling in my community in Stock Investing Mentor. And again, if you want to join, second link in the show notes below. Let me know what you think about the company moving forward in the comments section below. And don't forget to hit subscribe so that you can hear about what's going on with Duolingo when they report next in 90 days. Until then, Brian